Now let's take a look at the bigger picture. Jeffrey Small's with us, president of Arbor Financial. Thank you for being with us. I'll start with the breaking news here. And you know that FRC is now trying to shore up cash, selling off $100 billion asset sale. And we see that stock down over 40% today. But other stocks have had a lot of volatility along with it, such as Western Alliance, WAL, right? So it's sold off, it's come back a little bit, but it is still down about 7%. So the question is, shoe to drop, contagion, these regional banks. Where do you think most people think we stand at this point on this group?
What contagion? There isn't any contagion. The Fed has backed up every regional bank so far. Nobody's lost any money. The only contagion is the inversion of their balance sheets from the Fed's most aggressive interest rate hike in history, which is absolute insanity. Don't tell me the Fed had no idea that balance sheets and the CFOs of these regional banks and these local banks weren't going to become inverted due to the most rapid increase in rates in history. Economic excessive policies or change in monetary policy cause severe economic reactions. But fortunately, Nicole, this is going to be very limited.
Yeah, and so at this point now, I see what you're saying, right? So the contagion is contained because it's really just the few banks that got caught on this, is your point here. And so the question is, the rocky road ahead, is there one or not necessarily? Because the Fed has certainly shown that it's willing to back things up to a certain extent.
Well, you know, banks are tightening. The Fed is causing tightening because the cost of capital is costing a lot more cost across every element of credit and consumer loans and financings. And so what we're going to see going forward is not very much contagion. As a matter of fact, the major banks, guess what? Their earnings are going up. They're not going down. And so we do expect, though, the second quarter of 2023 to see maybe a 5% decline in earnings year over year. That should be the most severe shock we feel this year. And then a reacceleration of earnings in quarter three and quarter four, which, guess what, means that we've got maybe a 5% to 10% maximum market loss here and the readjustment for the second quarter. And so we're going to see the markets pick back up quicker than everybody realizes from here.
Right, understood. So at this point now, you know, we are sort of having some of the, you know, repercussions from the trajectory of those hikes, which you were talking about. I mean, it was just so fast how they were raising rates. And so the question is when they would pause. And what do you think now? We have a May meeting, a June meeting. What are you thinking? And what do you think they will do? And what do you think they should do at the Fed?
Well, you know, considering real estate prices went up today in today's Schiller report, I wouldn't be surprised if they raised things a quarter point because they really want to calm down the economy. Now, we know the economy really can't grow without a strong real estate market. And so homes are our number one asset as an individual consumer in this country. So we've got to have a strong real estate market, a strong home market for the economy to expand. It's going to be interesting to see, Nicole. They got at least one or two more quarter point bumps, and then I think they're done.
I see. In the meantime, you mentioned housing. Did you have any final thoughts here on that group? Because I do want to get to your stock picks.
Well, no real final thoughts on housing, but we are going into a recessionary period as per the Fed's own quotes. And so we had 7 straight declines in corporate net profit, 7 straight quarters of corporate net declines in net profit. And so, you know, that's going to bottom out here pretty quickly in the next quarter or two, and then we're going to start to see earnings reaccelerate. That will be good for the broader economy. We're probably going to be stuck in a higher rate environment for a while. I don't see us going back to normalized rates like we were in the discount rate from 2017 to the COVID of 2020. We're around 2 to 2.25. I don't see us approaching that. Maybe by the end of next year, midpoint next year, we're down at 3. The Fed's going to want to come in and not play politics next year and probably start lowering rates by January at the latest. Because if they keep rates high, guess what? Guess who they give the election to? They give the election to one side of the aisle. I won't get political, but that's what's going to happen.
All right. I'll leave that there. And thank you for your comments on that. And so at this point now, I want to take a look at some stocks, right? Because today,
Sure.
After the bell, we really begin a lot of these mega cap tech names. We'll be looking at Alphabet. What are you thinking here for Alphabet, Google?
Well, assuming we're approaching a corporate earnings recession, which we technically are in a corporate earnings recessionary direction, so you want to focus on stocks that are going to be value-oriented and still have the ability to grow their earnings going forward. This is the same thing I've been preaching on your show, Nicole, since December, when I picked Meta at $1.30 and it rose up 75%. And so stocks like Apple and Amazon and Google and Meta are all good positions. They're part of the group of 7 stocks that have really floated the market up higher this year, besides Tesla and Nvidia. And so those are the types of things you want to hold into your portfolio, especially you're going to get some good buys on those stocks over the next 2 to 3 months as we go through the second quarter earnings malaise. But after that, look for earnings to reaccelerate. Especially, you want to get into these stocks and dollar cost average before the Fed lowers rates or starts to, let's say, pause, so to speak, and become a little more dovish.
Understood. Okay, so at this point now, because we're going to be hearing from Microsoft and Google today, and then we'll have Meta coming out. Tell me about Meta and Amazon.
Well, we're going to see their earnings bottom out for all those stocks this quarter. This quarter, they're going to bottom out. This is going to be the time to buy. We'll see how the prices shake out after their earnings reports. But any earnings surprises by one of them could push prices up on all of them, even though some of them right now don't have positive earnings trajectory year over year. And so you want to be able to take advantage of this earnings report. So bad news on earnings is good news to purchase.
So if there is a pullback on these names, Google, Meta, Amazon, you buy, is that what you're saying?
Absolutely. A 5% pullback or more, you want to start averaging in.
Interesting. I mean, are you waiting for any other biggies this week? Because we have a third of the S&P 500 reporting this week. What else do you have your eyes on?
Well, I don't have my eyes on every stock out there, Nicole. I'm just really looking at about 5 or 6 stocks here that we like to hold at this point in time. They're going to be dynamic in an undynamic environment. Even if there is something that gets worse in the economy and we do face some significant headwinds, these companies are going to come out on top. Even if we go into a much more negative or harder landing in a recession, these are the companies that you want to own. So there is nothing else that I'm looking at. I want to own the best of breed with the best earnings potential at this stage, and that's how we should position defensively going forward if you want to be offensive-minded in stocks.
Yeah, understood. Jeffrey Small, thank you so much for your stock picks, but also for being with us right now on a day of breaking news and giving us some perspective on the group as well as those regional banks. Jeffrey Small, thank you. President, Arbor Financial.